Let's talk about some of the other positive factors out there for these banks. Equity capital gains, what can we expect to see there, and how much, I guess, excess money is hiding out in the markets for these banks?
Yeah, well, SMFG didn't book a large amount of equity capital gains, I mean, which is kind of a good thing in the sense that it means their underlying earnings are actually, stronger than particularly we would see at Mizuho, for example, which has been very reliant on these. The good news for the banks is that, because Abenomics had a very positive impact on the stock market, not great for interest rates, but good for the stock market, so that has raised the value of their equity portfolios. And these banks have $20, $30 billion of unrealized gains on their stock portfolios, so almost like whatever happens to their bond portfolios, which might not be good, if interest rates go up, they've still got very large gains on the stock, so they can sort of sell off those over the next few years, which they're doing to unwind these relationships which they've had for years. Corporate governance in Japan is changing, and so they can still, book some pretty substantial equity capital gains, and I think I'll be expecting to see that, as I mentioned, particularly at Mizuho, because their underlying earnings are so weak. They really needed these equity gains to support their net bottom line.
What about rising bond yields? How is that clouding the outlook, particularly in the US, I guess?
Yeah, well, we are seeing the banks have got very large bond portfolios, both domestic and overseas. The overseas bond portfolios have moved slightly into negative territory, and the current market value is a little bit less than the banks paid, so that sort of slightly hurt them, but it isn't very major in the overall context of their portfolios. I mean, clearly domestically is the big concern because they have huge bond portfolios, but the big banks have kept the duration relatively short, just 2 or 3 years. This higher interest rates in Japan is really sort of a double-edged sword, isn't it? That, as I mentioned, because lending rates have come down so much that they've been squeezed, almost any rise in interest rates in Japan, lending rates, would be really helpful for their margins. Of course, it would be a bit negative for the bond portfolios, but I think the bigger impact would actually be on Japan's regional banks, the smaller lenders. They're the ones who've gone a bit further out in terms of taking duration risk and more exposure there. And also, the other part of this sort of double-edged sword, if you like, if interest rates go up, banks can widen margins, but if they go up too far, then there's obviously a risk that some borrowers would not be able to repay their loans, and particularly these so-called zombie companies, which I think exist, in the sense that there are many businesses, particularly small businesses, which can survive with interest rates at virtually zero, but if they ever got up to a significantly higher level, then they might have a hard time. So higher interest rates might trigger sort of a credit quality problems. So a modest rise in interest rates definitely helpful, but if it goes too far, too fast, bad for the bond portfolios.